For more on the performance of Wall Street and the economy, Hugh Johnson joins us, Chairman and Chief Economist for Hugh Johnson Economics. Welcome to the show. Good to see you. I have to say this, Sam Bankman-Fried, while I know it's very separate from the economy, it symbolizes, I think, a year that we just went through where money was free, rates were low, and we were all hopeful on so many levels, on so many things, and ultimately things certainly did not work out the way we thought it was going to. And as we look ahead to this year in 23, there is some optimism, but a lot of that pessimism still remains. Why is that?
I think the principal pessimism, or reason for the pessimism right now, is looking at the economy for the first couple of quarters, not so much the second half, but the first couple of quarters. And the concern is that the U.S. economy is going to enter a recession first and second quarter. We have leading indicators for the economy. Those leading indicators that tell us where we're going, not where we've been, have been down for 9 successive months. It's very hard to build the case for positive growth in the economy when you have leading indicators declining as much as they had, obviously in response in part to the increase in interest rates engineered by the Federal Reserve. So first 2 quarters of this year, a decline in gross domestic product, that's the consensus. And along with that you're likely to get some downward revisions to estimates for earnings. So those are the kinds of things that really make for a stock market. And there's no evidence right now that the Federal Reserve is going to take its foot off the brake. It's pretty clear that they're going to raise rates when they meet in January and February, and they're likely also to do so in March. So no change right now. Leading indicators telling us the economy is going to contract, and most likely it will in the first 2 quarters.
Right, and lower rates are not the only stimulus that the economy had in terms of tailwinds. We also had what we would consider money printing, but basically monetary easing, where a lot of money was pushed into the economy aside from just rates alone. And then we also had a lot of government stimulus plans that were handed out to corporations and people. We're not going to have that same effect in 2023. And I got to think that that's a pretty big difference alone, just aside from rates themselves. That's a big difference.
That's a huge difference. And people don't really quantify or sit down and quantify the magnitude of what you're talking about. The level of stimulus in 20 and 21 in order to try to help get us out of the pandemic was $6.4 trillion. That's in large response to the Federal Reserve adding financial assets to its balance sheet. That's all gone into reverse, and now they're reducing the size of their balance sheet, and as a result, we're getting a decline in the level of money or liquidity, the stuff that really drives the economy and the markets. And in fact, we have a decline in assets held by the Federal Reserve, and the growth rate of the money supply is now down to less than 1%. There again, it's very hard to make the case that you're going to drive the economy and you're going to drive the financial markets with liquidity or money conditions that weak. It's just not going to happen.
We don't want to drive the economy. We want inflation to drop, and the only way to make inflation go down is either you make a lot of stuff and we just flood the markets, or you hit demand, right? We call it demand destruction, and we're seeing maybe a little bit of that. But the job market's still very strong. I mean, if you talk to some of the bulls out there, the job market's still strong, earnings are still strong, employees are still out there working, companies still have a ton of jobs that are open that are unfilled. I mean, at some point, there's the bearish people and the bullish people. What's in the middle? What is a happy, healthy compromise?
I kind of take a little bit of an exception to one of the comments or the comments that you're making. First of all, the strength of the job market. Yeah, there's no question. 263,000 jobs which were created or added to payrolls in the month of November. That number is going to come down to about 180,000 when we see it on this Friday. And when you take a look at the numbers over the course of the last 6 months, yes, we've added a lot of jobs to payrolls, but at the same time, the number of jobs we've added each month keeps coming down. The second thing you mentioned is the amount of spending being done by consumers. If you take a look at the November numbers on personal spending, adjusted for inflation, it was actually down. So we're seeing a slowdown in the growth rate of jobs, a slowdown in consumer spending, all very consistent with this concept or the idea that the economy is not only slowing, but is likely to continue or likely to start to contract when we get into the first and
Right.
second quarter. So we're not seeing anywhere near the strength that everybody's talking about.
And with that said, looking out 6 months, where should we, I guess, think about putting our money in terms of the areas of the economy versus the things that we're worried about that would be worse than expected, say 3 to 6 months from now?
Well, that's a great question, and I think that the part of the answer to that question is when you look at the history of the equity markets, you'll see one thing that jumps right out at you, and that is that bear markets are accompanied by recessions. Of 23 of the 25 bear markets we've seen, and those bear markets do not end until you get into a recession. They end during a recession or during a hard landing. So we have to have, number one, the hard landing. So quite frankly, bring it on. In the first and second quarter, if we do get that hard landing, you have the conditions for a turn in events. And I think that the reason you have a turn in events is because at that time, first or second quarter, the Federal Reserve is likely to respond to the decline in inflation, which is likely to continue into 23, the slowdown in the economy and maybe contraction in the economy, and they're likely to respond by taking their foot off the brake, number one, and number two, they might even get around to reducing interest rates when you get towards the latter part, fourth quarter of 2023. And those are the conditions under which you'll get a turn in the stock market. You'll start to see indicators telling us that the Federal Reserve is taking their foot off the brake is going to have positive results, or basically the economy is going to turn the corner. And that's when stock prices will do better. It's during a recession. So bring it on. I think that's what's going to happen.
Hugh, you had me a little worried earlier on, but now after hearing you say that, I'm actually a little more excited, and I'm going to keep thinking positive, and we're going to talk to you again. Fantastic having you on. Thank you very much.